Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Higher energy prices drove Canada's inflation rate up to 2.8% in April, reaching its highest level in nearly 2 years. The conflict in the Middle East continued to push up gasoline prices last month, which rose by 28.6% from a year ago. While price growth reached its fastest pace since May of 2024, it was still lower than the rate economists were expecting. And Agnico Eagle is moving ahead with a large gold mine in Canada's far north. The company has given the green light to the Hope Bay mine in Nunavut and plans to spend more than $2 billion on initial capital costs. The mine is expected to produce more than 400,000 ounces of gold annually. And we're also watching shares of Home Depot this morning. They are moving to the downside after a key metric in the retailer's latest quarter missed expectations. Sales at locations that were open at least a year rose 0.6%, which was slightly below analyst estimates. Adjusted profit beat expectations, though. Home Depot's business has been hit by elevated interest rates and high housing prices. And we're keeping an eye on U.S. futures this morning. It seems as though tech is leading stocks lower today before the opening bell. The Nasdaq, in particular, down by 0.6% at the moment. And we'll continue to watch for that and for the TSX also today. You can see where it closed on Friday. It was down by about 33,000 points, just below that 34,000 threshold. We'll continue to watch that for you this morning as well. The world's largest home improvement retailer is out with its quarterly earnings. Home Depot slightly beat on earnings per share and reaffirmed its 2026 guidance, but sales were slightly below estimates. So let's get some perspective this morning from Dan Rohinton, portfolio manager at IA Global Asset Management. He joins us in studio. Good morning.
Hey, good to see you.
So let's start with Home Depot, obviously, because that's what I was just mentioning. What are some of the key takeaways that you noticed in the latest earnings report?
Yeah, it's really sluggish is the name of the game here. And what's happened with Home Depot is you had such a huge surge in COVID, and you've had a hangover for a few years. And it's important to understand when it comes to this high interest rates, they tend to take a bite out of transaction velocity of homes, Lindsay. Mm-hmm. And then with that, then you don't feel the urge to feel like you're getting a return on your remodel and repair. So that kind of slows down Home Depot's core business. And they don't really grow stores all that much. So they're very sensitive to the actual comparable store sales metric, which is 0.6. That's not enough to keep driving operating leverage in the business. So you saw gross margin come down a little bit, and you see operating margins under pressure because you have to make some offsets here and there. So is it a brutal quarter? No, but it's in the context of the valuation, which is pretty cheap because there's really a demand shortfall that we're trying to search for here.
And that's interesting, too, because I was looking at, it left its outlook unchanged for the year. We're getting into the time of year where people are going to Home Depot maybe a little more, renovations, getting their yards up and running for the summer. You're not surprised by the fact that they didn't change their outlook?
Yeah, because usually there's seasonality to Home Depot's business, so it's all true from prior years. So what investors like ourselves do is we look back to how was their Q1, how was their Q4, so we look at their prior stacked comps, as it's known. So that really tells you that their 0 to 2% guidance for comparable store sales, it's just within the realm of what you would expect, and it's nothing all that special. And most analysts have it about 1.1, 1.2. So nothing great, but the stock's at relative lows, especially in a pretty strong market. So that's why you're not seeing a weaker result this morning.
Okay, nothing great, but nothing crazy either. I want to move on. There's another story that you want to talk about today, and that's Google and Blackstone, which have launched a massive new AI cloud business. What's so interesting to you about this? I mean, tell us more about what you know about what's going on here.
So this is in the context of the strongest month that the semiconductor index has had in the better part of 25, if not 30 years.
Wow.
So that usually, there's this idea that, these companies do extremely difficult science, and even the neoclouds, which are the competitors to your Microsoft Azures, your Google Cloud, and Amazon Web Services, these smaller upstarts are trying to nibble away at the big companies. And Google comes in with a joint venture with Blackstone saying, yeah, we're going to get into that business too on the low end. And really this strategy is private equity muscling into data centers in a bigger way where they're selling third-party compute. And Google is just the chip partner for that. I have a lot of questions about what this means over time for Google and how much silicon they really have to spare for their internal workloads. But there's a reason why a Nebius, a CoreWeave, an Iron, Applied Digital, all these stocks are under pressure here because this tells you that the tail end of the capital stack is still open and capital is flooding into this space. And if I may lean on to this one step further, what you need to focus on from here for the next few years is that we are seeing a convergence in the US economy and many parts of the global economy under the AI theme. So what was historically a tech isolated cycle is now going into more conventional balance sheet centric areas. So if AI misses, the repercussions and the ripples will be far greater. And if AI is successful, the rewards will be more distributed as well across more sectors. So I'll stop there.
What is AI, when you say like if AI misses? Because no one really talks about that. Like what does that really mean? What does that look like?
Yeah, so AI missing, and I'll give a perfect example of it, is AI missed in the consumer landscape. And I know it's a crazy thing to say that almost 1 billion people use ChatGPT on a weekly basis. Sorry, monthly, I apologize. And that is considered a miss because the propensity for users to pay for the premium subscription just isn't there. So AI missed extremely lofty expectations in terms of how much consumers would adopt it, but enterprise, the businesses, are adopting it at a rapid pace. So if enterprise say, maybe this is too expensive, we're going to dial it back, we're going to slow it down, that downstream missing of the growth forecast then goes into, well, maybe we'll buy the chips a year later. Maybe we'll slow down the permitting of this data center. And suddenly all the power companies, the electrical companies, the semiconductor companies, that ripples all the way down. So missing doesn't mean that we're not going to grow adoption. It just means we're not growing it exponentially, which is where the current plans are.
Right, and there'd be quite a stall if that were to happen, as you say, like the trickle-down effect. Before we move on, like Blackstone's planned $25 billion investment in scaling up this AI cloud infrastructure. How significant is that to you, that investment? Like, what does that look like?
You know, the irony about it is it's very quaint in the context of everything else that's being built out. So it's only about 500 megawatts. There's other clusters that are being built that are several gigawatts. So to put it into, let's put it into Ottawa perspectives, because it's the last data point I have.
Right.
This is about like 1/8 of an Ottawa. There's bigger data centers that are basically the size of Ottawa in terms of how much their full demand is for the gigawatts that they're going to consume. But all that being said, it just tells you that this is the toehold and it could expand further and further and further. So it becomes a capital shootout game, which is just worse for investors in the neoclouds especially.
Interesting. Okay, moving on to another thing that you wanted to touch on today, and that is a federal jury throwing out Elon Musk's lawsuit against Sam Altman and OpenAI, basically saying that Elon Musk he should have filed sooner.
Basically.
What do you make of that?
It's one of those interesting things. There's a lot of palace intrigue in this AI race amongst the big labs, because you have a lot of people that have moved around. So OpenAI's founding team with Sam Altman and Greg Bachman don't get along with Anthropic's team. So we're talking about trillion-dollar companies where there's deep personal animosity between the investors. And Elon Musk is in the fray because he founded OpenAI with Sam Altman back in the day. So he lost it on the technicality, but he is probably going to refile. And these are all distractions going into probably the first of 3 trillion-dollar IPOs that are coming later in this year. So SpaceX is going to go first, but what's holding up OpenAI is this type of, call it palace intrigue that's going on between the old founder that got kicked out and so on and so forth. But what this also means is if you're investing hundreds of billions of dollars, because they did a $120 billion capital raise, that is OpenAI, you don't want a lawsuit saying the Series A at the seed stage was funded by a guy who got kicked out. Now he's suing to get XYZ% of the company. So this all throws gum in the wheels of a company that should be one of the marquee IPOs of our time.
What would that do, though? Like, is that just, it just sounds to me like that would just be bad PR. Is that more than that?
The settlement could be tens, if not $100 billion, if not more. So what the jury awards is such a huge unknown that if you're an investor buying the IPO, you don't know if you're going to get a 10% dilution, a 0, or a 20. And that's that type of thing where when you're in a capital-intensive business like AI, that's pretty impactful for dilution.
For sure. Okay, before we wrap up here, OpenAI, as you mentioned, eyeing an IPO later this year. Would you be a buy on that if that goes through?
Depending on the valuation, yes.
Why?
And I go back to, there's all the things I'm saying sounds really negative. Oh, there's a lot of capital being thrown into it. But these are some of the most productive uses of technology we've seen in a generation. So do I think that the technology is going to distill into society? I do. Do I think it's going to have rewards for society? I do. I have a very positive view of AI as we move further, while acknowledging there are negatives as well. So it comes down to, if OpenAI's valuation is within the realm of sub 8 times revenue and lower, given the capital intensity of it, it doesn't deserve the same software multiple. Consider me interested. If it starts going into, crazy land, 20 times sales, 30 times sales, where you really have to believe in the really blue sky scenarios, I'm a little bit cautious. But it really depends the price, the valuation, and the revenue run rate at the time of the IPO. And we're in this exponential where if I'm wrong by one turn, it could really change the entry price. So I hesitate to say, but that's my framework for thinking about it.
Interesting. Okay, we will leave it there. Dan Hinton, always enjoy having you in studio. Thanks so much for coming in. Dan Hinton, portfolio manager at IA Global Asset Management. Coming up, we will bring you an in-depth look at the markets, and we'll also tell you why business leaders in one Canadian province are sounding the alarm over AI energy demands. More on that next. Welcome back. We're going to do a quick market check here. We're going to start with the Asian markets to see how they finished the day today. A bit of mixed trading overseas. The Nikkei down by 0.4%. The Hang Seng and the CSI 300 up at the moment. This is mixed as the Iran war kind of has some uncertainty rattling Asian stocks and oil prices. Of course, that ongoing conflict in the Middle East that we're watching for. Moving over to Europe, we'll see how things are trading there today. All in the green at the moment, advancing as investors welcome news that the U.S. has paused an attack on Iran after comments by Donald Trump. You can see the German DAX in particular up by more than a full percentage point. We'll take a look at U.S. futures. Of course, opening bells are in about 15 minutes from now. Not the same story over here. Tech seems to be leading stocks lower today. The NASDAQ down by 0.7% in early trading. So we'll continue to watch that for you today as things get underway. Again, that's about 15 minutes from now. We're also watching the TSX. We'll show you how it closed on Friday. It was down quite a bit, below 34,000 points, down 1.27% to finish the down Friday, watching to see if maybe there could be some rebounds today, especially after a long weekend as well. And we'll take a look at the price of metals as well. Gold, silver, and copper all down to start the day as the markets kind of monitor updates on the war in Iran. Gold down by 0.6%. But look at silver, down almost 2% at the moment. Copper also, after seeing a real run last week, is down more than a full percentage point as well. And we're watching the price of oil, of course. It is falling. It's down by 0.5% after Donald Trump says, of course, we told you already, he called off those apparent planned strikes in Iran following an appeal by the Persian Gulf allies. And you can see the price of oil responding to that this morning. And we're also watching the loonie. It is slipping on lower than expected CPI data. We know that inflation in Canada has hit the highest it's been in about 2 years. So we'll continue to watch that today. The loonie is reflecting that as well. And then we're also watching the price of Bitcoin. It's at a 2-week low as a pullback in demand and turmoil in the Middle East prompted traders to back out on their positions. So it's below 80,000 now. Ottawa is pushing industry to adopt AI, but some PEI business leaders warn that the province's power grid may not be ready to support the added demand. CTV's Maria Soro has more in this report.
Talking trade, technology, and what it takes to grow, Canada's industry minister was in Charlottetown this week. But as the federal government pushes AI adoption, some business leaders worry PEI's power system will struggle to keep up.
We seem to be, on the precipice of an energy crisis right now.
The province's electricity supplier has warned PEI could face shortfalls at peak times and has prepared customers for rotating outages when it reaches maximum capacity. Nationally, Canada's energy regulator says the rapid growth of AI applications is a significant contributor to rising energy demand and requires substantial computing power.
We've got a real opportunity to grow and grow really fast, but we just won't be able to do it if we don't have energy and power.
Most of the island's electricity comes from New Brunswick through 4 subsea cables. Two are nearing end of life, and the provincial government says replacing them is a high priority. But that will require federal funding, and PEI has applied for preliminary support. When asked about funding for provinces, Canada's AI minister pointed to the National Electricity Strategy launched this week, which aims to double grid capacity by 2050.
There is a huge focus on making sure we've got baseload power and that we've got the energy grid to support the future.
Back on the island, hands went up at another business event when keynote speaker Jane Arnott asked who is already using AI.
AI is here. It is everywhere. It's being used all the time for operational efficiency.
The next hurdle is for island infrastructure to handle more demand. Maria Sru, CTV News, Charlottetown.
Coming up, we will turn our attention back to the inflation story after Statistics Canada released its April CPI data that came in below estimates. And we'll talk about that right after this quick break. Stay with us. Canada's inflation ticked higher in April, rising to 2.8%, driven by soaring energy prices. The price of gas rose by a whopping 28.6%. So let's get some reaction from Pedro Antunes, chief economist at Signal 49. Good morning. It's great to have you join us.
Well, good morning. Thanks for having me.
What do you make of the numbers we're seeing? How does this line up with your expectations?
Well, I guess we're pleasantly surprised. We were thinking we might hit above 3% on the top line inflation numbers. So it's good news. There's some other aspects of inflation that have come down a little lower than trend. I'm talking about rent and food prices perhaps easing a little bit. The transportation costs as well, like the travel costs have come down a little bit, which was a bit of a surprise. But we're obviously very worried about this top line inflation. I think the central banks are very worried about this because it's hard to deal with for a central bank when the economy is weak and you have a supply shock that affects essentially energy prices and gasoline prices. So it's going to be a challenging environment, I think, for central banks for until this war in the Middle East gets settled.
Yeah, I mean, is that kind of the driving factor here? Obviously, we saw that really high increase in energy and gas prices. Were you expecting that to be so high?
No, that we were pretty much in line with the actual numbers came out. We know that there's a lot of things happening within just the gasoline price itself, but the bottom line is, we've got oil prices that are nearly double where they were at the beginning of the year, and that's still 3% direct hit. It's 3% of the consumer's basket is gasoline, so that's the direct hit. The concern, I think, for central bankers is, we're a repeat of what we saw when Russia invaded Ukraine and we had a commodity price increase because, essentially energy feeds into everything and feeds into transportation, for example, just very broadly. And so if this lasts, then it's going to start to have an impact on essentially everything that we certainly import and most of what we consume more broadly. So, this is, again, the concern. The bottom line is this shock, this energy price shock, it's already leading to high inflation. Could it lead to, worse outcomes for the economy more broadly?
Mm-hmm. I do want to talk about interest rates in a moment, but I just want you to explain that because I feel like there's a bit of a disconnect there, right? Because as you say, energy prices affect the prices of a lot of other things, food prices, transportation, as you say as well. But there seems to be a bit of a disconnect from what we're seeing in the numbers coming out today in terms of energy going up, some of these other prices going down. Is it just it's going to take a while before we see that?
It's just temporary. I think we're going to see it. I know that we're seeing surcharges in air travel, for example. These things will all end up feeding the bottom line. But yeah, again, the concern here for the central bank is around inflation expectations. So even though core inflation is still kind of within the band, when households start seeing essentially what they're paying for at the pump, they're seeing top line inflation numbers close to 3%, then that drives essentially their wage expectations. And following that shock back in 2022, where we had a commodity price shock that fed into just prices in general, and then we were 2 or 3 years with wages trying to catch up to that loss in purchasing power. And it took a long time for central banks, not just in Canada, but across the developed world, to get inflation expectations back down. And I think this is a concern that, again, the longer this war lasts, the more likelihood that we're going to have this inflation build into expectations, and much, much tougher for central banks to deal with.
And it seems to be that way already. Like Bank of Canada expectations for a January rate change have increased slightly. We know that Tiff Macklem said they feel as though the inflation rate is going back towards that 2% target. That was last time we heard from the governor of the Bank of Canada. It's obviously not going in that direction. So what do you make of rate cuts, rate hikes this year? What do you think we're going to see for the future of 2026?
Again, this is tough for the central banks to deal with, because the central banks only have one tool, and that is to raise interest rates to slow economic activity, and then that tends to get inflationary pressures down. But when you have an underlying weak economy, I mean, the Canadian economy right now is not very strong at all. We've seen very soft employment numbers. We've not seen a lot of investment yet. We're hopeful for that, and certainly our trade sector is getting hammered. So it's not a strong outlook to begin with. And what's driving inflation, it's not a heated economy. It's essentially this supply shock that we're feeling. So it's, again, very tough for central banks to deal with. They're going to be, I think the central bank for now is going to stand pat. They're not going to move at all. We were already at a point where the central bank feels, I think, that their interest rates are at neutral. In other words, they're not taking away nor adding to the economy at the current point. I doubt we'll see rates being lowered because of this supply shock. So I think the central bank is probably going to stand pat unless we start to see this get built into inflation expectations. And then, if anything, we may see interest rates come up. We're already seeing signs or hints of that in the U.S.
It's interesting, too, when you think about it. It was about a year ago that Ottawa removed the consumer carbon price, about a year earlier. Did that, do you think, skew the annual price comparison in April for this year?
Yeah, well, I think that's now coming out of the numbers, essentially. I do think the policy around lowering the essentially the excise tax on gasoline, that is one way to kind of lower top line inflation. I know it's still high. Gasoline prices are still high, but the excise tax, that's a fiscal policy that is removing 18 cents a liter, and that will help reduce top line inflation and perhaps help the central bank in its fight against this top line inflation number. In fact, our inflation numbers at 2.8 are a lot weaker than what the U.S. had in the same month at 3.8%. And the situation is even worse for Europe and other developed economies. And then this comes back to the point where, again, this is a global energy price shock, so it's not just Canada. This is going to be impacting purchasing power across the world, and I think the repercussions in many other countries are going to be a lot worse than for Canada. We're still a net exporter of oil. There's still some positives here with high energy prices.
Okay, we'll have to leave it there. Out of time. Pedro Antunes, Chief Economist at Signal 49. Always good to have you on. Thanks so much.
Have a good day.
You too. And stay with us. The opening bells are next. We'll be right back. Here are the opening bells at the NASDAQ. And chaos is ringing the opening bell this morning. At the New York Stock Exchange, Cava rings the opening bell. And on the TSX, Hive Digital Technologies is opening the market and celebrating the company's graduation to the TSX. It's time now for the first 15. You are watching BNN Bloomberg. Trading is just getting underway this morning, so we're going to check in on the equity markets now that the ball is rolling. We'll start with the TSX. Looking at where it ended last week, it was down about 400 points on Friday. So you can see it is up to start the day. It's up by about 1.1%. So we'll see if it can make some more gains throughout the day. The S&P 500 trading down. The NASDAQ also trading down. It seems as though, just like in pre-market trading, tech seems to be dragging down U.S. stocks a little bit. Keep watching that for you. We're also, of course, watching some Canadian companies. Agnico Eagle is one that we're watching closely today. It has announced it's going to build a $1.7 billion gold mine in the Arctic. This is a project that has been welcomed by Prime Minister Mark Carney as an anchor for Arctic economic development. The Prime Minister has been quite vocal on building things up in the Arctic. You can see, though, Agnico Eagle to start the morning is down by more than a full percentage point. And for movers south of the border, we are now joined by Jeff Morgan. He is deputy team leader for the Bloomberg News Equities team. Jeff, good morning. So we're going to start with Amer Sports today. It is climbing after full year guidance boost. Tell us more.
That's right. Yeah, Amer Sports is climbing. It boosted its full year guidance. It now sees about 20 to 22% revenue growth over the course of 2026. That's ahead of about 16% revenue growth that it had previously expected to experience over the course of this year. And what's going on here is this is the company that is behind the brands Salomon as well as Arc'teryx. And those two brands are gaining in popularity in the United States. And as a result, this is a Helsinki, Finland-based company with a U.S. stock ticker that is getting a big lift today. Truist was out this morning that pointing to kind of the strength in those two brands. It's also worth noting we're kind of at the point in earnings season here in the U.S. where we get a lot of looks at the U.S. consumer and U.S. consumer trends. Looks like from the beginning here we're seeing a lot of strength in those two brands, Arc'teryx and Salomon, and that is lifting this stock so far today.
Interesting. We're also watching Home Depot. We were speaking about this a little earlier this morning, but sales have fallen short on lackluster housing recovery. Some mixed results in the latest quarter. Tell us more.
Yeah, mixed results. The stock started the day trying to figure out where it wanted to go, and then the earnings call started at 9 a.m., and it has been trending lower as a result. Now, worth noting here, so as I said, we are in the middle of kind of a handful of consumer names reporting this week. We'll also see Walmart coming soon. Home Depot, Bernstein was out this morning with a note saying that the same store or the traffic trends for Home Depot sales have been negative now for 5 straight quarters. A handful of analysts on Wall Street pointing to what they think is what they're calling maybe a bumpy bottom for home improvement spending in the U.S. And so far, the stock is getting a little bit, 0.5% down. Not so bad, but yeah, definitely negative trends that a handful of analysts are calling out here. Definitely worth watching as we look at a handful of additional names coming this week.
Yeah, as we heard earlier this morning, not crazy results, but not exactly as great as expected for Home Depot. Okay, Bloomberg's Jeff Morgan reporting live for us this morning. Jeff, thanks so much. NVIDIA reports on Wednesday, and oil is now past $100 a barrel again. So how to balance your portfolio between stocks and commodities? More of that coming up after the break. Markets gave a cold shoulder to Donald Trump's China visit, but all eyes now turn to AI darling NVIDIA. Will its earnings be the make or break moment for the bull run? Joining us now to break it all down is Diana Avigdor, VP of Portfolio Manager and Head of Trading at Barometer Capital Management. It's great to have you join us. Good morning.
Good morning, Lindsay. Thanks for having me.
Lots to get to here. I want to kind of start more big picture. Markets, oil prices showing some erratic moves to start this week. What's driving that action, do you think?
I think that what's driving the erratic action in the market the last few days has actually been the bond market. Yields are shooting higher. Equities don't like volatility in the bond market. It's not so much the level of rates, although about 5% on the 30-year has been conceived as a little bit treacherous, but it's not the actual level of rates that matters. It's the volatility with which it gets there. In the last few days, we have seen yields shoot up. And equity markets have taken the brunt of it. Oil volatility, it's not as much as it has been, actually. Up a few percent, down a few percent. We've seen a day last month when it was down 10%. That's volatility. But definitely the elevated level of oil certainly is going to start seeping into numbers, although we haven't seen that we have seen that in the Canadian CPI, actually. Energy prices were up 30%, but nothing else. So, and companies have been able to manage this so far. Earnings season has been absolutely fantastic. So it's bond yield volatility that's bugging the market right now.
But what's driving the volatility in the bond markets?
Yeah, so, we have a new Fed chair coming in to the U.S. It's been sworn in just now. The markets are pricing in a 60% chance of a rate hike into year end. That was almost at zero just a little while ago. The numbers coming in, the economic data coming in are showing an economy that's doing well. employment is doing well, but the pricing components are moving up. So we've gone from almost 100% expecting rate cuts a few months ago in the U.S. To rate hikes in the last little while. And that's what the yields are reflecting, that change in scenario.
Got it. Okay, so let's move on to Donald Trump's visit to China. There were very high expectations going into that meeting, but the markets seem to have given it a cold shoulder now that it's done and Donald Trump is home. How do you rate the outcome of that meeting between the two?
Yeah, so, it was a nothing done. Came back with nothing on the Middle East war, came out with just a friendly handshake, and we haven't seen any headline, and that was a little disappointing in terms of wanting to see some kind of cooperation, coordination on the war front. Had we seen headlines to that effect, we would have seen oil not where it is right now at $109 because ceasefire has been announced. The market's not giving any credence to Trump saying that, nothing is going to happen militarily in the near term as requested by the Gulf states to allow for more negotiation. But an agreement between the U.S. and China to together do something about this conflict would have gone a long way to the price of oil.
Mm-hmm. It's interesting because obviously we have our own negotiations here in Canada coming up with the U.S. This summer. Do you think Canada should take any lessons from what we just saw in China?
I think that what people miss in the USMCA negotiations is that some of those agreements actually do not expire, even if there's some non-renewal. Some of those agreements that have been put in place have another 10-year run rate. But I do think that the relations are cool. I think Bank of Canada knows this, and with a slack in the Canadian economy, Bank of Canada has not been cutting rates, has been holding steady. I think part of that decision has to do with the USMCA negotiations. Should they not go well, it could hurt in certain pockets, and rate cutting is in the pocket as a possibility to do it then, as opposed to preemptively.
Okay, so we're also watching for more earnings this week, including NVIDIA, which is happening tomorrow. We've seen across-the-board earnings beats this season. Does that put more pressure, do you think, on NVIDIA?
It certainly is, because the expectations are just so lofty. It's a really high bar to beat. Expectations are for 79% year-to-date revenue growth, 84% year-to-date EPS growth, and the expectation for guidance is around the same. We have never seen a company with this kind of growth. And if we factor in growth into the PE, then suddenly the PE doesn't look that high, PE to growth ratio. Mm-hmm. So definitely, but this is a theme that's not going away. So momentum stocks and the momentum stocks have actually rallied so much since the March lows. S&P in general has rallied 17% since March lows. I think a check back is due, and momentum stocks tend to trade really volatile. In terms of the market and how this might be affecting it, aside from violent moves, markets go down in a sustained fashion when it's pricing in a recession. We don't believe we're ahead of that. We are managing for inflation. But like I said, aside from violent moves, and we could have a little bit of a violent move, especially in the high beta, but NVIDIA has been underperforming the rest of its peers. It's only up 20% year to date. You've seen some of the others up a lot more, over 50%. So I'm smiling because 20% is a very nice return, but it has just broken out. So we'll see. We'll see if it holds. We'll see if the current sell-off actually positions it for a better entry into the earnings number.
Just lastly, what's the best way to kind of balance a portfolio right now, especially with the AI boom on one side, high energy prices on the other side?
So there's other stocks that you can own definitely that play into other things, but as well as the data center theme. One of the ones that we like in our portfolios is some of the industrials. For example, Caterpillar. You look at the chart on Caterpillar, you look at their earnings, they've consistently come in expectations and beat. But one of the great things, it's characterized as an industrial, but it also has a connection to the power theme. They make natural gas turbines that go into powering data centers, and it's a high margin, high growth business. It posted 22% growth, revenue beat estimates, even on this 22% growth expectations, and despite tariff headwinds. And there is one more thing that comes for this company. It's a good time in the cycle for mining companies to start buying machinery. Usually comes 12 to 18 months into a cycle, and we're there. So this company is firing on all cylinders and is tied in. So it balances out some of your higher beta volatility stocks.
Okay, we'll have to leave it there. Diana Avigdor of Barometer Capital Management, always great to have you on. Thanks so much.
Thanks, Lizzie.
Just ahead, NextEra shares are down again today after it announced that mega deal yesterday to buy Dominion Energy, creating what will likely be the third largest energy company in the U.S. Details on that after the break. Yesterday, NextEra Energy announced it is going to pay $67 billion in stock for Dominion Energy in the biggest power acquisition ever, creating a giant utility extending from Florida to the artificial intelligence data centers clustered in Virginia. So for more on this, we are joined now by Bloomberg energy reporter Emily Forgash. Emily, good morning. Great to have you join us. So I guess to explain to us why NextEra is actually doing this. Like, what does this deal do for them right now?
Well, it makes NextEra, which is already the biggest utility by market cap in the U.S., even bigger. And that's really important right now during the AI boom, because to meet that demand, these utilities are having to spend trillions of dollars in the next 5 years. And so a bigger market cap means that they can back that spending. So now it's going to get even bigger. Also, NextEra needs to rebalance its business. It's done really well in its unregulated renewable development arm, and now it needs to get back to its regulated utility roots, and that will help. This transaction will help bring its regulated arm back up to 80% of its business.
And so what does this deal mean for the future of utilities and consolidation in this sector?
Yeah, so analysts have told me that they think that this deal might portend more mega deals in this space because other utilities will similarly want to get bigger and bigger. So they definitely don't think this is the last, although this is by far the biggest transaction of this nature in the history of this country.
And how does Dominion and Virginia, where it operates, benefit from this deal as well? Like, let's get the other side of this. Can you explain it?
Yeah, definitely. So as you said, Virginia is where a bunch of the data centers are clustered in this country, and it's been struggling to meet that demand. The grid operator, PJM, has been under fire for not connecting data centers fast enough and for pushing price increases onto ratepayers. And Dominion has also struggled to meet that demand. And so bringing NextEra on helps bring in more battery, storage capacity, renewables to help meet that demand with an entirely bigger utility in the region.
Okay. Bloomberg's Emily Forgash joining us live. Emily, thanks for that. Appreciate it.
Thanks for having me.
Friday on Market Call, we were joined by Eric Nuttall. He is a partner and senior portfolio manager at 9 Point Partners. He was covering energy stocks, and his top picks were Cenovus Energy, Strathcona, and Whitecap Resources. Today on the show, we have Rebecca Telcher joining us. She's portfolio manager at New Haven Asset Management, and she will be taking your questions on Canadian stocks. So be sure to tune in. That's 12 p.m. Eastern Time. Coming up, we will hear how China's dumping of coal is causing one coal company to shift its focus to other minerals. More on that after the break. Stay with us. Ramaco CEO Randall Atkins joined Bloomberg to explain why China's steel dumping has hurt coal markets and why the company is betting big on rare earth mining. He says that is the toughest hurdle in building a U.S. rare earth supply chain that's independent of China. Take a listen.
Well, the met coal business has been challenged for about a year and a half by China. Essentially, China has been dumping steel on the world markets. That's had a dramatic effect on price. It's also had a dramatic effect on other economies that have steel production having to cut back on feedstock costs like iron and met coal. So that's essentially what has been dragging the industry as a whole down really for about the last year and a half. And I think you're starting to see some signs of actually a contraction in supply, which may show itself in the back half of the year and hopefully strengthen prices somewhat.
How does that contraction come about? I mean, dumping is the kind of thing that tariffs used to be made for. Is the administration doing something about that Chinese dumping? And what do you expect the back half of this year to look like in terms of met coal and really steel?
Sure. So the dumping is obviously the steel being overproduced and put on the world markets. The tariffs have some modest impact, but at the moment we sell about 2/3 of our met coal overseas. So those are the markets that are really being impacted. And to the supply side, what's happened is that the market has contracted so much over the last year or so that you're starting to see bankruptcies again. You're starting to see contraction in supply by mines being shut down. You saw a large sale of a met coal property today by one of the Australian groups. So I think some point in the next several months, you're going to start to see the supply and demand balance hopefully come into a little bit more of a sync.
All right, let's talk about the Brook mine in Wyoming, I believe. This is where all the hype is around critical minerals for Ramaco. Are you going to transition to that as a main business, or is this just an option that you've got?
Well, actually, we've got sort of two critical mineral businesses. We've got obviously our met coal business you've referred to, and then an emerging rare earth business. And one of the things we're doing internally is kind of segregating ourselves into various internal divisions. So at the end of the day, we will have separate producing operations for both rare earth and critical minerals running sort of distinct from each other.
So you have like $500 million in liquidity, and so I was just wondering how much you put towards the rare earths side of the business and how much goes into met coal. I guess you've got that operation up and running, so
Sure.
You don't really have to do much.
Sure, that's correct. We have some mines that we could grow production on the eastern side of the United States in. And a lot of that cash, as you mentioned, will go into rare earths. But there's more to come because, as you pointed out in that excellent article that was in your print publication last week, the amount of capital that has to go into developing the United States rare earth industry, if you will, particularly on the processing side, is going to be immense. So although we've raised a lot of capital, there's still a lot more to go.
Explain to investors what's happening with the stock, because you had just a tremendous spike last year. You've come off what looks like it was somewhat unsustainable this year, and even year to date, you're off about a fifth. So what's going on with Ramaco Resources stock?
Sure. Well, the run-up in the stock occurred last summer and early fall. If you remember, that was the period when the U.S. first started investing, if you will, in private rare earth operations. They did a deal with MP Materials. There's others that followed. We were caught up in that exuberance, if you will. Our stock traded almost into the high 50s. And then in October, frankly, when Trump met with the Chinese, they came away with the notion that the rare earth problem had been solved. And really all companies that were touched by the rare earth dropped rather materially. That chart right there kind of demonstrates that we were trading somewhat in sync with some of the others.
By the way, rare earths, I mean, the mining of them is one part of the process, but as far as I understand it, processing them, separating them is at least an equally difficult task. How do you plan on dealing with them once you get them out of the ground?
Well, they have to be processed and refined, and as you point out, that is a very complicated effort. It's also a very expensive effort. It's probably the equivalent from the petroleum business about essentially taking the crude and then refining it in a large industrial plant complex. So that will be our next step, and because you're dealing with really minute parts per million. The picture behind me is of our mine out in Wyoming. Imagine, mining millions of tons of coal and then having to find parts per million of rare earth inside that. So the separation and processing is indeed always a challenge.
And do you partner with somebody, Randall, to do that?
No, we're going to do it ourselves. We actually have brought on board some of the world's leading experts in processing. We've actually come up with some unique techniques that we can deploy for coal, because most rare earths are found, frankly, in hard rock minerals, which are radioactive. Ours are found in coal, which is soft and does not contain radioactive material. So we'll take a different tact on the processing.
Stay with us. We've got more coming up right after this. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. Higher energy prices drove Canada's inflation rate up to 2.8% in April, reaching its highest level in nearly 2 years. The conflict in the Middle East continued to push up gasoline prices last month, which rose by more than 28% from a year ago. While price growth reached its fastest pace since May of 2024, it was still lower than the rate that economists were expecting. And we're watching shares of Agnico Eagle today. The miner is going ahead with a large gold mine in Canada's far north. Agnico has given the green light to the Hope Bay mine in Nunavut and plans to spend more than $2 billion on initial capital costs. The project has been hailed by the federal government as an anchor for economic development in the Arctic. And billionaire founder of Lululemon, Chip Wilson, says he is looking for a constructive path forward in his dispute with company management. In a statement, Wilson said there is no reason a resolution cannot be reached quickly. Wilson, who is one of the retailer's largest shareholders, has applied pressure for changes to the board, arguing that Lululemon needs new directors to help find a way out of a sales slowdown. And we're watching the TSX after it lost hundreds of points to close on Friday. It is down ever so slightly at the moment. Continuing to watch that for you today. We're also watching U.S. markets, where it seems, at least in pre-market trading, tech was dragging stocks lower. That seems to still be the case. The Nasdaq down by 0.6%. The S&P 500 down by about 0.5% at the moment. With oil prices climbing and inflation concerns lingering, investors are treading carefully in today's volatile markets. But our next guest says opportunities remain for those who can cut through the noise. Joining us now is Molly Perroni, president at Yacktman Asset Management. It's great to have you join us. Good morning.
Good morning. Thanks.
So what's your take on what we're seeing in terms of the direction of the markets today?
Yeah, it appears to be a lower open, to your point, driven by the tech stocks moving. At Yacktman, we invest for the long term. In fact, we've been in Microsoft since 2003 in varying sizes. So at any given day, market moves aren't going to impact the way that we invest at Yacktman.
In terms of sectors or specific companies, what are you choosing to avoid right now and why?
Yeah, we think a lot about risk at Yacktman. In fact, we consider ourselves business owners, and we have a business owner mindset when we look at companies. We don't like leverage, as an example. Leverage, especially in these type of interest rate environments, as well as this type of, what can happen to market capitalization very quickly. That just adds to the risk. Adds to the risk of any company. So we often consider ourselves allergic to debt on the balance sheet.
Okay, and we do have some stock picks. I do want to get into those in a moment, but without giving any of those away, what parts of the market are you leaning into right now?
Yeah, we invest across all sectors. We do have significant positions in the energy sector at present, as well as select parts of the tech market as well.
Okay, let's get into your stock picks then. In particular, these are on your radar. So Canadian Natural Resources is the first one. Tell us what opportunities you're seeing here right now.
Well, we actually love Canadian Natural Resources and actually invested in the company back in 2021 when COVID had hit. The entire sector was trading down to like 2% of the entire market. And actually, for a bit, energy prices even went negative. So we looked really closely because we think a lot about price at Yacktman, and the prices for investing in some fabulous companies became really compelling to us. And as you know, Canadian Natural Resources, right up there in Alberta, is an oil sands company. So essentially, you're just manufacturing the oil. There's not as much risk as you see in some of the other energy players who have to go find the oil. At CNQ, we actually know the oil is there, and it's got 30 plus years of reserves right, at their disposal. The other thing we would point out about CNQ is they're very early leaders in being very smart capital allocators, like we've seen other companies do in the energy sector. They've been, I think it's 26 quarters of increasing dividends, and the management team is just absolutely terrific. So we really like Canadian Natural Resources. I also just saw that the pipeline is getting the final bits of approval in Alberta, and that will actually offer a very interesting new vector, perhaps, if the oil sands companies are able to then provide their oil for the Asian countries who are getting hit especially hard with the conflict in the Middle East.
Mm-hmm. How do you think CNQ will factor into that? That pipeline project is obviously down the road if it does happen, but I mean, where do you think they'll sit within that?
Yeah, I think many of the companies, including CNQ, will be really beneficiaries of being able to export Canadian oil more broadly than they are able to today. I think that's a definite plus for CNQ.
For sure. Okay, let's move on to your next one. That's Samsung Electronics. You say Samsung's on track to be one of the most profitable businesses in the world this year. Tell us more.
Yes, we've been investors in Samsung for quite some time as well. There's basically three legs to the thesis. One, you own a memory business. So you got what we've seen in some of the US-based companies like Micron, but you have Samsung and SK Hynix in the mix as well. So you've got a really strong memory business that is absolutely a core part of the AI build out, and in many cases has become the bottleneck. So whereas you used to see memory being a cyclical industry, with kind of just very commoditized supply, and now all of a sudden they're doing take or pay contracts out 3 to 5 years and really selling out capacity. So the prices have moved accordingly in the memory space. You've also got Foundry, which, when we think about Taiwan and some of the risk in the geopolitical arena, you've got an ability to invest in Samsung that's, one of the world's leading foundries. In fact, here in Texas, where we're based, they built out, I think it's 1,200 acres of a foundry project, and they've invested $20 some odd billion so far, and there's another 30 to 40 to come in just a very large and cutting edge foundry factory where you're doing some of the most high precision manufacturing on the planet. And we like to see a second sourcing to TSMC, which is the leading chip foundry in the world, but it's also unfortunately placed in a pretty controversial part of our planet. We also in Samsung, you of course have the phone and the other consumer electronics business as well. So in a way, it's like Micron and TSMC and Apple all rolled into one global chip company that you can actually technology company that you can actually invest in and own for extremely low price, which is, again, how we think about it. Yacktman, it's almost always about the price. And we're able to look at something that's a very compelling multiple relative to its competitors in each of those spaces.
Lastly, U-Haul, another stock you like right now. Tell us why.
Sure. And as you can tell, we're generalists if we're investing an energy company and a tech company and U-Haul, which is kind of part of the story. U-Haul is the truck rental company and self-storage business that you may be familiar with. In fact, when you're out on the highways, you'll see U-Hauls actually doing their very own advertising by the customers driving the trucks. It's got two basic lines of business. The trucking side and the self-storage side. And it doesn't cleanly fit into a sector. It's part of why we think it's an undiscovered name, because they don't break out their financials into the trucking business versus the self-storage business. And if you look at what's underlying in terms of their share in each of those businesses is extremely strong. And if you were to compare it to recently, there was a self-storage business that was purchased by a competitor. If you applied that same type of valuation methodology to U-Haul, you're essentially getting the trucking side of the business for free. And you've got one of the leading trucking businesses out there. It's kind of like the Kleenex brand if you think about self-moving.
Interesting. And as you say, such a diverse group of stock picks for today. Great stuff. Molly Pironi, president at Yacktman Asset Management. Appreciate you joining us. Thanks so much.
Thanks, Lindsay.
Coming up, AtkinsRéalis reported a Q1 revenue beat, and we will speak with the CEO on that and more right after this. Stay with us. AtkinsRéalis reported a beat in revenue last week amid slumping growth in the U.S. and tensions in the Middle East. For more, we are joined now by Ian Edwards, CEO of AtkinsRéalis. It's great to have you join us. Good morning.
Yeah, good morning. Thanks for having me back.
What attributed to this beat that we're seeing in the latest quarter?
Yeah, really good quarter. Very pleased with progress in both halves of the business. I mean, the global engineering services business actually grew 5% organically. We also concluded 3 deals in M&A in the quarter. And the nuclear business just keeps going from strength to strength. We had 37% growth in the quarter, and we're seeing wonderful opportunities going forward in our nuclear set.
I did want to ask you about that. Nuclear, obviously a major driver this quarter with strong revenue growth. How sustainable is that pace beyond 2026? Like, how much of this is kind of long-term energy security trends versus short-term projects that you're seeing?
Yeah, I mean, we're all seeing this kind of energy crisis unfold, such that countries around the world are looking for energy security and long-term baseload power. We're also seeing the demand of AI really drive energy demands across the world, and the hyperscalers themselves are looking for their own solutions to provide for their data centers and AI factories. So nuclear is a real credible alternative now. I mean, I travel the world meeting energy ministers. I travel and have met this quarter a lot of hyperscalers. And it's a very, very exciting time for our specific technology, which is the Canadian Indigenous technology, which has very, very many differentiating factors, not least of which is the fact that we have a very capable nuclear business and ecosystem in Canada that we can deploy to build capacity for the demand ahead. So I think it's a very sustainable situation of demand.
When you're talking about energy security and infrastructure, what do you see as the biggest driver for this? Is it the AI build-out or more geopolitical, as you were mentioning?
I think both. I mean, for sure, the AI build-out is stretching the grids, and the hyperscalers themselves are really looking for solutions. And, we've been engaging those hyperscalers, and we're putting our technology through the licensing process in the U.S., so that we can be ready and deploy for them. But what's been interesting revelation for me personally is that there was always a concern about nuclear in terms of how long does it take to build and get available power. But actually now gas is probably one of the biggest kind of favored technologies right now. It's suffering from big backlogs in manufacturing, and our technology now is becoming comparable from a time perspective. So that's a game changer. But also, most countries around the world are finding this renewable kind of move towards net zero and energy security a challenge. And 38 countries around the world have now signed up to the COP28 pledge to triple nuclear power. So you're seeing a lot of countries put nuclear into their policies, which is clearly great news for AtkinsRéalis and Canada as a whole because of our nuclear technology.
Backlog has now reached $20 billion. You are converting backlog into revenue. Is that conversion accelerating, or is it kind of taking longer given the complexity of some of these projects?
Well, I mean, we've been actually looking at record backlogs through many quarters last year, and obviously we've got a strong backlog now. There are opportunities on both sides, which are bringing new projects into the fold. We had a good Q1 of work winning. So as our revenues are increasing and growing on both sides of the business in engineering services and nuclear, we're also winning as well. So we would see this continuing for the foreseeable future, for sure.
You've also been pretty active on acquisitions. What's the strategic goal here? Is this about growth, margins, or kind of reshaping the business?
Yeah, on the engineering services side of the business, we want to call out what we fill out the white space, so to speak, where we see good geographic opportunity for our capabilities. Australia has been a target because we're seeing good energy capability there, good energy opportunity, and we're seeing good defense opportunity. So we've actually announced 3 acquisitions in Australia to give us a platform for growth. But the US is definitely a priority for us. We see a very strong market there. We are probably playing at around about the number 15 player, and we want to be in the top 5. So we've acquired a couple of businesses there, and you'll see more coming through. Again, to build out our capability across the country, we can complement that with our nuclear technology, and we can acquire both transportation and energy and power projects across that country, which clearly, is a long-term sustainable market for ourselves.
And just lastly, you also returned capital to shareholders this quarter. I wonder how you balance that versus investing in growth and M&A activity as well.
Yeah, I mean, we take the opportunity. We've got a very strong balance sheet. We have strengthened that balance sheet over the previous years. We're actually, we've got no debt. We're actually carrying negative leverage. So as we see fluctuations in the share price, we will buy back. But one of our priorities is still M&A for the long-term growth of the business. So it's a balance between both returns to shareholders and looking at the longer term for growth in the business.
Okay, Ian Edwards, CEO of AtkinsRéalis. Appreciate you joining us. Thanks so much. Coming up, markets are under pressure amid extreme volatility. So what is the best ETF strategy to navigate the swings? We will find out right after the break. Welcome back. It's time now for the ETF report. Markets are caught between fresh geopolitical pressure and a tech-led rebound. Oil is climbing, yields are moving, and investors are looking for where to turn next. So joining us now to break down where the ETF opportunities are is Chris Peak, Senior Portfolio Manager at Harvest ETFs. Good morning. It's great to have you join us.
Good morning. Great to be here.
So I guess, first of all, what are the driving forces right now when it comes to both the positives and negatives that we're seeing in the market?
Volatility is probably the biggest negative right now. And, obviously, Iran conflict still going on. That's leading to inflationary pressures. It's causing fixed income volatility and equities like certainty. And, we continue not to have a heck of a lot of certainty in equities. So those are some big drivers. But, on the other side of the equation, we've got some, positive kind of earnings quarter that we're emerging from. We're on relatively firm ground economically. We continue to be constructive, but there's a lot of risk to manage, and certainly, that's creating volatility in the markets.
Earnings held up. Tech is leading again, although it might be bringing the markets down a little bit this morning. Is that enough, though, to trust this market through the second half of the year?
I think equity investors have to have a certain level of trust. Equities investors do tend to be rewarded for that trust over time. But, I think what you also want to be mindful of is just the concentration of returns that we've seen recently. The semiconductor space is up somewhere around 50% in the last 6 weeks. So, for it to be down a little bit today seems perfectly ordinary, and perhaps, even a longer pause might be ordinary. So, I think equity investors should have trust, but they should also be balanced and also look for ways to take advantage of that volatility as well.
Where do you see the action and opportunities in ETFs right now? Is it like in equities and commodities? Where is it?
Yeah, also maybe start with, if it's good, bad, and ugly, kind of the more uglier is the fixed income market right now. Yields have been relatively low. Yields are getting higher, but they're still low. And I think investors are largely mistrustful a little bit of what fixed income can do in portfolios. So that's been a very tough space. Perhaps we get to the point where that becomes a little more stable and investors will say, hey, I can get, a good yield there. That's a tough space. Really equities has continued to be the focus. Recently we have seen some chasing of returns in technology as they've had these really strong markets. Other areas investors have deployed, which I think makes sense from a rounding out a portfolio point of view, is in areas like gold or utilities or infrastructure. Looking beyond the U.S., so Canada has had pretty great performance over the past couple of years, even 2 to 5 years, with that more commodity exposure. We've seen interest there, and kind of lastly is a lot of what we do at Harvest is adding income through selling volatility through the covered call strategy, and that extra income that can be collected, is really a unique way to take advantage of volatility in the marketplace. So we've continued to see a focus on investors seeking to earn that extra income in these volatile markets through such strategies as we offer.
Right, and you mentioned right now that your strategy is more focused on selling puts on Canadian banks. So that's the ETF we're going to get to in a moment. But as we talked about, you've seen extreme volatility in the markets. There's a strong run in Canadian banks. Where can investors kind of protect and benefit right now?
Yeah, so with that backdrop, that's why we launched this strategy earlier this year in January. It's the Harvest Premium Yield Canadian Bank ETF, the ticker HPYB. There's a lot of covered call products in the Canadian bank space. This one uses puts as well as calls as well as equities. And the advantage with using puts is, if you sell a put kind of below where the stock price is, it can do a couple things. It can, number one, give attractive income stream and take advantage of the volatility in the market and provide that income. But it also gives a potential to buy the asset, in this case Canadian banks, at a lower price if the price sells off. So it's more of a defensive approach where we're looking to generate income and buy on weakness. The Canadian banks have been anything but weak, as we know, fantastic returns. But, they're sitting at definitely the top end of the valuation range. So we like banks long term, recognizing they're a little bit over the skis on a shorter term basis. Selling the puts, we think, makes a lot of sense. And that's what we're doing. We're really focusing a lot on the put side in HPYB.
Okay, Chris Heek, Senior Portfolio Manager at Harvest ETFs. Appreciate your time today. Thanks so much for joining us.
Thank you very much.
Coming up, we will bring you your latest headlines and we'll update you on the markets right after this. You're watching BNN Bloomberg. Higher energy prices drove Canada's inflation rate up to 2.8% in April, reaching its highest level in nearly 2 years. The conflict in the Middle East continued to push up gasoline prices last month, which rose by 28.6% from a year ago. While price growth reached its fastest pace since May of 2024, it was still lower than the rate economists were expecting. And shares of Sherritt International are getting a lift today. The company says it is no longer proceeding with the dissolution of its Cuban joint ventures, including its split from Cuba's General Nickel Company. It will instead maintain the suspension of its direct participation in the activities. Sherritt says it is evaluating ways to mitigate the impact of the U.S. sanctions, and it cautioned that any transaction or restructuring remains preliminary and may not be completed. We're also watching shares of Agnico Eagle today. The miner is going ahead with a large gold mine in Canada's far north. Agnico has given the green light to the Hope Bay mine in Nunavut and plans to spend more than $2 billion on initial capital costs. The project has been hailed by the federal government as an anchor for economic development in the Arctic. And we're keeping an eye on North American markets this morning. all trading down at the moment. The TSX, the S&P 500, and the NASDAQ down more than a full percentage point to start the day. Tech stocks definitely dragging U.S. stocks lower. We'll continue to track that for you. We're also watching the price of gold today. It was retreating earlier, still is, as the market monitors updates on the war in Iran. Donald Trump coming out with some strong words to start the week. You can see gold is down more than a full percentage point at the moment. And we're also watching the loonie. It is trading down today after those CPI numbers for Canada came out earlier this morning, showing inflation has ticked up. And that's dragging the loonie down by 0.2% compared to the U.S. dollar. Bitcoin, meanwhile, is at a 2-week low, so it's below 80,000 once again after seeing a bit of a run over the last couple of weeks. This pullback is in demand and turmoil in the Middle East, prompting traders to back out on their positions. And then, of course, speaking of the Middle East, we're also watching the price of oil. It is falling after Donald Trump says he called off reported planned strikes in Iran following an appeal by the Persian Gulf allies. You can see the price of oil down today by 0.6% at the moment. One Alberta resident says when an oil well runs out, they are often abandoned. So who takes care of the abandoned wells in Alberta's biggest oil producing province? One Alberta resident says an abandoned oil well on her property poses some significant safety risks. CTV's Kathy Lee reports.
For more than a decade, this rusting oil field storage tank has sat untouched on Kelly Nelson's farmland after the company that operated it went under.
Nobody owns it. Nobody claims it. It's not under the Orphan Well Association at this point either.
Nelson now plans to contact the Orphan Well Association, the group responsible for cleaning up sites that no longer have an owner.
There's hazards, right? Like you've got gases and all the rest of it that might be there.
The environmental risks are just one part of a much larger problem. After the collapse of Calgary-based long-run exploration, more than 4,000 inactive wells and sites were added to the Orphan Well Association, doubling its inventory. But Philip Meinzer with Coalition for Responsible Energy warns the fund isn't keeping up with the growing number of sites.
If those cleanup costs fall on the taxpayer, that's public money. That's money that should be funding our schools. That's money that should be funding our hospitals.
A natural resources law professor says provincial and federal tax dollars, including $1 billion in COVID-19 era funding, have already been used to help clean up inactive wells.
We're talking, $1.5 billion of public money that has already gone into this process.
Sean Fluker says weak regulations allowed inactive and aging wells to build up across Alberta without enough financial safeguards to ensure companies could eventually pay for the cleanup.
I don't see us finding a viable solution to this problem without a true and full public inquiry. We're talking hundreds of thousands of wells.
The province has stated that tax dollars will not be used to clean up private oil wells, but this farmer remains skeptical.
I don't know what the answer is. I honestly don't, because these companies have disappeared.
Saying she worries taxpayers could ultimately be left holding the bill. Kathy Lee, CTV News, near Shoaldice, Alberta.
Ottawa is pushing industry to adopt AI, but some PEI business leaders are warning the province's power grid may not be ready to support that added demand. CTV's Maria Saru has more in this report.
Talking trade, technology, and what it takes to grow, Canada's industry minister was in Charlottetown this week. But as the federal government pushes AI adoption, some business leaders worry PEI's power system will struggle to keep up.
We seem to be, on the precipice of an energy crisis right now.
The province's electricity supplier has warned PEI could face shortfalls at peak times and has prepared customers for rotating outages when it reaches maximum capacity. Nationally, Canada's energy regulator says the rapid growth of AI applications is a significant contributor to rising energy demand and requires substantial computing power.
We've got a real opportunity to grow and grow really fast, but we just won't be able to do it if we don't have energy and power.
Most of the island's electricity comes from New Brunswick through 4 subsea cables. 2 are nearing end of life, and the provincial government says replacing them is a high priority. But that will require federal funding, and PEI has applied for preliminary support. When asked about funding for provinces, Canada's AI minister pointed to the National Electricity Strategy launched this week, which aims to double grid capacity by 2050.
There is a huge focus on making sure we've got baseload power and that we've got the energy grid to support the future.
Back on the island, hands went up at another business event when keynote speaker Jane Arnott asked who is already using AI.
AI is here. It is everywhere. It's being used all the time for operational efficiency.
The next hurdle is for island infrastructure to handle more demand. Maria Sru, CTV News, Charlottetown.
Still ahead is Hot Picks. We will zero in on 3 software stocks for your portfolio when we come back. Stay with us. It's time now for Hot Picks, and today we are zeroing in on 3 plays in the software sector, including a high-risk buy. So for more, let's welcome in Stephen Enders, Vice President and Senior Equity Research Analyst at Citi Research. Good morning. Great to have you join us.
Great. Thanks for having me. How are you doing today?
Great. I hope you're doing well as well. I'm interested to talk about the software sector because just before we get into your picks, it's had quite the year so far, as I know you're aware of. Is it past the rebound stage? Is it still in the rebound stage? Where are we at right now?
Yeah, I think we're still trying to figure out exactly where things are heading and where things are trending. I think there's a lot of focus on what's happening with AI and the opportunities or the risks that kind of come from that and the disintermediation that could potentially come through. So I still think we're sort of figuring out where things are at. It kind of feels like maybe we found a bit of a new bottom here and maybe can feel a little bit more stable and support moving forward. But it always kind of feels like we're a headline away from the sentiment again kind of changing and reversing course. And I think that still kind of remains a bit of a risk right now for the entire sector.
Okay, so maybe on some wobbly ground. With that, though, let's get into your first hot pick for today. This is what you say is the high-risk buy. Pegasystems Incorporated. Tell us more.
Yeah, so I think Pega has been one of those companies that maybe is a little bit of an underappreciated AI beneficiary across the landscape. I think you think about their roots; they're really good in automating workflows, and I think there's concerns in the market around what that means in an AI world if more of the decision is going to be put onto some of these model companies. Having said that, I think the kinds of workflows and the applications that Pega is really working on, I think are a little bit more kind of focused and centered in more complex kind of use cases where you have 100+ step processes and you have a lot of decisioning that kind of goes into it. And I think for the companies that they work with, it's a lot of regulated industries, a lot of banks, insurance companies, and the government. And I think the workflows that they tend to work on, I think are areas where there's probably more hesitancy to fully trust AI with those processes. I think it's one of those things you can plug in certain aspects of it into the workflow and some of those agentic capabilities as one part of the bigger process with Pega. And I think when you think about what they're doing with AI, they're really kind of putting into the forefront of their go-to-market and their product strategy, where it is helping them, I think, ease the on-ramp of their own product set and utilizing their blueprint strategy, which is their Gen AI strategy, to really simplify how customers are coming to them and utilizing Pega and getting out the gate in a more efficient way. So I do think there is more opportunities for them to drive growth. You've seen ACV accelerate or their ARR accelerate, expecting to accelerate further going into the back part of this year. And so I do think that they are benefiting from Gen AI, but you still have all the concerns and risk that's weighing on sentiment for them.
Okay, next up, Appian Corporation. I'm not sure if I pronounced that right, but tell us more about this company.
Yeah, Appian, so they're kind of in the same space as Pega, where they are kind of like a application platform helping companies automate complex workflows. I think in a similar perspective with Pega, I think there's a lot of fears about disintermediation and what could happen if more of these application workflows end up becoming codified with agents or other AI systems. But at the same time, I think when you look at the types of workflows and the use cases that Appian is kind of playing in, it's a lot of things that are in highly regulated industries. 30% plus exposure into the federal government. They're winning larger contracts within the government space as well, including a $500 million ELA with the U.S. with the Army. And so I think there's a lot of those kind of initiatives that are still kind of going on. You think about what's happened with the DOGE and government efficiency over the past year and a half. I think Appian is a company that stands to benefit from that. And I think you're starting to see that in the numbers. We're seeing cloud growth accelerate, and you're seeing revenue pick up as well. And AI is a big piece of that. I think they just disclosed that they have $100 million of ARR coming from their AI tier. They're seeing really good adoption. I think 1,000+% growth in some of the AI usage this past quarter. And so there's a lot of things that I think are going right there that are still underappreciated, because you do have that kind of longer term concerns if they could potentially be taken over by AI. But I don't think we're seeing that. I think if you look at the fundamentals, things are still really healthy right now for Appian.
Last topic was Box Incorporated, which you say looks like it could have some substantial growth by the end of this year.
Yeah, so I think that's another name where I think we see AI actually helping them accelerate, and I don't think people are fully kind of appreciating the opportunity that comes with it. They've really leaned into their enterprise suites opportunity over the past few years. The newest tier, which has only been out for about a year or so now, is already about 10% of revenue. Still only kind of mid-single digit penetrated across the customer base. I think if you think about what that means, if you kind of get that tier across the rest of the customer base, that's a 30 to 40% kind of uplift. I think they're at 70% plus penetration of suites already. I think that's an area where there's more that they can do. And I do think, again, you're kind of seeing an acceleration, should continue. And I think you look at their agent strategy and what they're doing with AI. I think that there's a lot that they're doing on kind of the forefront, the cutting edge of technology, and integrating with all the major model vendors. I think they're working really well with the Anthropics and the OpenAIs and trying to be a big part of that content strategy moving forward for organizations. So I think we feel pretty good about the fundamentals on Box. Think that what they're doing is still pretty underappreciated, and think that you think about the disintermediation risk with AI. I think that there's a lot around the content side that is harder to replicate when you think about the security and the governance and the actual file capabilities there. So feel good about what's happening with Box right now and the long-term strategy here.
Interesting. Okay, we are out of time, but Stephen Enders, Vice President and Senior Equity Research Analyst at Citi Research. Appreciate your time. Thank you so much.
Awesome. Thank you.
Coming up, we will bring you an interview with two tech heavyweights from the Dell World event in Las Vegas, and we'll hear from both NVIDIA CEO Jensen Huang and Dell CEO Michael Dell, and we'll hear how the demand for memory is outpacing capacity. More on that after the break. NVIDIA CEO Jensen Huang and Dell CEO Michael Dell discussed agentic AI and the demand for memory with Bloomberg on the sidelines of the Dell World event in Las Vegas. The conversation began with Dell talking about the trends he's seeing driving demand for his products.
I think the change we see is it's kind of moved from testing and evaluating into production. And we showed some great examples on stage, right? With Eli Lilly with 1,000 GPUs.
In the physical world.
It's Samsung. And these are not things that are on the screen, right? This is in the real world with the largest companies in the world. And so it's propagating broadly across all customers in every industry, in every country. And, you see the improvement in all the models, and now we have the agentic capabilities. And so while it is exciting and there's been a tremendous amount of growth, I still think it's just the beginning of this wave, particularly when it comes to enterprise, which is really where, we have an enormous opportunity.
What's so fascinating, Jensen, is you've spent 4 years telling me that we needed to change the definition of the computer. in a context of accelerated computing. But the big focus was on the hyperscalers, right? Cloud. What I took from Michael's presentation was this is happening, you said locally, but on-prem. What's the NVIDIA interpretation of that part of this cycle?
Intelligence has to be produced at the point of context. And so wherever the context is, wherever the action is, that's where you want to produce the intelligence. For most of the early applications of AI, it was in the cloud. A lot of consumer services are in the cloud. However, for Lilly, Samsung, the future manufacturing, a lot of companies, you want the agents to be on-prem because that's where all of your data is, where all your secure data is, your proprietary data, and all of the skills associated with your company is. And so now we have agents that are here, AIs that can do work.
Right.
ChatGPT was fantastic. It launched generative AI.
But it just made content. That was it.
Making content is very important, but doing work is really valuable. And now we're doing productive work incredibly well. That's why they're called agentic AI.
In this new era, what everyone is trying to work out is, aren't all the GPUs locked up at the hyperscalers? How is Michael Dell going to service those 1,000 new clients with the GPUs to build their own on-prem local AI factory?
Well, the supply chain that Jensen has built, we built together, is continuing to scale up. And while it's true that there's more demand than supply, there's more supply that's being added, and customers are figuring out how they start to scale these systems up. So, I think what's also happening is companies are understanding that when they reimagine their workflows using this technology, they don't get 10 or 20 or 30% improvement. They get 10 times or 20 times or 100 times. And that is really the speed that matters to make a business successful. We're doing it ourselves. NVIDIA's doing it. And so it's not a secret anymore that these things are possible. And every company wants to capture that speed and translate it into competitive advantage and outcomes.
Dell was the sales channel, right, Jensen? Michael's company is very good to selling technology to America's biggest companies. How is that going to change things for NVIDIA going forward? Like the makeup of the types of companies we're talking about are at scale, but there's also that kind of middle market of data center that's being built, different kinds of it in the industrial space, in healthcare. Is that something that puts NVIDIA into new territory, away from the frontier labs, away from the hyperscalers?
Well, NVIDIA is a technology company.
Right.
The hyperscalers have the ability to take our technology and integrate them, operate them into a service. Dell has the ability to take our technology, turn them into a solution that delivers impact to customers. If you look at what has happened, agentic AI has completely, as we were talking about earlier, reinvented computing. We had to do several things together. The first thing, of course, we had to build the brain. This is the Grace Blackwell NVLink 72, the Vera Rubin NVLink 72, giant large language models. The second part now is the Vera CPU that we're now in the process of launching. The highest performing CPU in the world. It's designed for agentic AI. And now this will be the harness running the agent itself, using the tools.
Would you kindly, Jensen, what does harness mean? What's the
harness? Harness is what puts a harness around the large language model so that it can access memory, access the network, use tools, have local scratchpad memory, working memory, access long-term memory. And so that harness basically turns, if you will, the brain into an agent, okay, into a digital robot, if you will, that can do work. And so now the agent runs on a CPU. We also worked with Dell to create a new type of long-term memory for agents. We call it the Dell AI Data Platform. That's built on NVIDIA. The networking to scale it out is built on NVIDIA. So the agent, the brain, the long-term memory, all of the networking necessary to scale it up, as well as the agent runtime itself, we call it NemoClaw, running in a secure and governed container called open shell. All of that has been put together, and now the technologies are the technology parts. What Dell has to do is turn it into a solution that people can use. Dell will do for the world's enterprises what the clouds do for the clouds. Makes perfect sense.
What is the Dell story, Michael, around CPU and sort of like general purpose computing in the agentic era? We've talked a lot about the AI factory offering, the GPU, but actually there's potential for you in more general purpose workloads. The build-out's happening either way.
It is, and the demand is exceeding the supply there as well, as you know. And look, as you move to these agent frameworks inside companies, you use a lot more CPUs.
Yeah.
And that's just the reality of what's happening, and I think that's only going to increase. So instead of humans using tools, it's now agents using tools. And agents, as you were talking about earlier on stage, we have 1 billion people. We'll have hundreds of billions of agents. People use tools every now and then. Agents are going to use tools all the time, and agents use tools very quickly. And so we're going to need a lot more CPUs, and those CPUs are connected to GPU brains so that the CPUs know how to think, how to reason, how to plan, and how to use those tools. So that's basically how it works.
A surge in longer maturity U.S. Treasury yields is testing the resolve of global bond investors torn between the possibility of locking in the rates near the highest levels in decades and the risk of an even greater sell-off. For more, we are joined by Bloomberg's Michael McKenzie to break this down for us. It's great to have you join us. Thanks so much. Tell us exactly what's going on here and the decisions to be made.
Well, it's turning out to be an absolutely barnstormer a day here in the bond market, and not in a good way. Yields are rising rapidly. The 30-year bond yield has hit its highest level since 2007. The market's pricing in more potential rate tightening from the Federal Reserve, and Kevin Warsh is about to take the helm when they have their first meeting in June. So clearly the bond market is worried about inflation, stronger, resilient growth in the economy, and there's also a sense here that maybe the Fed cut rates too much last year, and we've essentially got interest rates resetting at higher levels and actually moving into higher trading ranges. And so the bottom line for the economy is that homeowners and people looking to buy houses and take out mortgages are going to be hit with higher borrowing costs. The same will go for all these AI data centers that need to be funded. Future bond sales will come at a more expensive level.
As you mentioned, we're seeing the bond sell-off right now. How much of that is being driven by the wave of tech companies issuing debt to fund AI and data centers at the moment?
Well, they've issued bonds in corporates, and a lot of investors have been happy buying corporate bonds. But ultimately, it just means that future debt sales will now come at more expensive levels. It also would suggest that if Treasury yields continue to rise, corporate bonds are priced off Treasuries. So again, people who bought those bonds would now be underwater.
Is this mainly an inflation story or a deficit story? Is it both?
It's a combination of all. I mean, the U.S. economy is holding up pretty well here. The unemployment rate's around 4.3%, so that's historically low. The economy is trucking along pretty well. We've had a lot of fiscal stimulus come through tax refunds in April. So that's holding up consumer purchasing, even with the rise in gasoline prices. You then have an inflation problem. The Fed has failed to get its inflation back to target for the last 5 years. And if you think back to what happened in 2022, the Fed had to start making some very aggressive rate hikes to the tune of 0.75 percentage point in increments in order to try and get inflation back down from that 9% level. As it stands, last week's inflation data suggests that next month could come in with a 4% handle. So inflation is definitely trending in the wrong way. And then you have the deficit. So the US is running a mammoth deficit, which is sort of precedented outside of wartime. We're running above 6%, 6.5%. And debt to GDP has just crossed that recent threshold of 100%. So again, every time the bond market sells off, it's increasing the cost of borrowing for the US government, and interest rate expense surpassed the defense budget a couple of years ago.
Right.
So this is a huge problem for the US administration and Congress.
Bloomberg's Michael McKenzie joining us. Michael, appreciate that. Thanks so much for your time. That wraps up this edition of The Open. Morning Markets is up next with Roger Peterson. Stay with us.